An introduction to financial forecasting defining forecasting inputs. The main inputs of forecasting include time series, cross-sectional and longitudinal data, or using judgmental methods. Key points forecasting is the process of making statements about events whose actual outcomes, typically, have not yet been observed. Time series is a sequence of data points, measured typically at successive time instants spaced at uniform time intervals. Cross-sectional data refers to data collected by observing many subjects at the same point of time, or without regard to differences in time. A longitudinal data involves repeated observations of the same variables over long periods of time, often many decades. Judgmental forecasting methods incorporate intuitive judgments, opinions, and subjective probability estimates. Key terms: probability sample, a technique of studying the population subset in which the likelihood of getting any particular subset may be calculated. Dow Jones Index, an index that shows how 30 large publicly owned companies based in the United States have traded during a standard trading session in the stock market. Non-probability sample, a subset of the population in which the probability of getting any particular sample may be calculated, and therefore cannot be used to represent the whole population. Forecasting and accounting in corporate finance, investment banking, and the accounting profession. Financial modeling is largely synonymous with cash flow forecasting. This usually involves the preparation of detailed company-specific models used for decision-making purposes and financial analysis. A financial forecast is an estimate of future financial outcomes for a company or country for futures and currency markets. Using historical internal accounting and sales data, in addition to external market and economic indicators, a financial forecast is an economist's best guess of what will happen to a company in financial terms over a given time period, usually 1 year. Challenges: arguably, the most difficult aspect of preparing a financial forecast is predicting revenue. Future costs can be estimated by using historical accounting data. Variable costs are also a function of sales. Forecasting versus financial plans and budgets. Unlike a financial plan or budget, a financial forecast doesn't have to be used as a planning document. Outside analysts can use a financial forecast to estimate a company's success in the coming year. Forecasting is the process of making statements about events whose actual outcomes, typically, have not yet been observed. A commonplace example might be the estimation of some variable of interest at some specified future date. Prediction is a similar, but more general term. Both might refer to formal statistical methods employing time series, cross-sectional or longitudinal data, or less formal judgmental methods. Time series data. Time series is a sequence of data points, measured typically at successive time instants and spaced at uniform time intervals. Examples of time series are the daily closing value of the Dow Jones Index or the annual flow volume of the Nile River at Aswan. Time series analysis comprises methods for analyzing time series data in order to extract meaningful statistics and other characteristics of the data. Time series forecasting is the use of a model to predict future values based on previously observed values. Time series are very frequently plotted via line charts. Cross-sectional data. Cross-sectional data refers to data collected by observing many subjects, such as individuals, firms, or countries/regions, at the same point in time, or without regard to differences in time. Analysis of cross-sectional data usually consists of comparing the differences among the subjects. For example, if we want to measure current obesity levels in a population, we could randomly draw a sample of 1,000 people from the population, also known as a cross-section of that population, measure their weight and height, and calculate what percentage of that sample is categorized as obese. For example, 30% of our sample may be categorized as obese based on our measures. This cross-sectional sample provides us with a snapshot of that population at that one point in time. Note that we do not know based on one cross-sectional sample if obesity is increasing or decreasing. We can only describe the current proportion. Cross-sectional data differs from time series data, also known as longitudinal data, which follows one subject's changes over the course of time. Another variant, panel data, or time series cross-sectional (TSCS) data, combines both and looks at multiple subjects and how they change over the course of time. Panel analysis uses panel data to examine changes in variables over time and differences in variables between subjects. Longitudinal data. A longitudinal study is a correlational research study that involves repeated observations of the same variables over long periods of time, often many decades. It is a type of observational study. Longitudinal studies are often used in psychology to study developmental trends across the lifespan, and in sociology to study life events throughout lifetimes or generations. The reason for this is that unlike cross-sectional studies, in which different individuals with the same characteristics are compared, longitudinal studies track the same people, and therefore the differences observed in those people are less likely to be the result of cultural differences across generations. Because of this benefit, longitudinal studies make observing changes more accurate, and they are applied in various other fields. In medicine, the design is used to uncover predictors of certain diseases. In advertising, the design is used to identify the changes that adverts have produced in the attitudes and behaviors of those within the target audience who have seen the advertising campaign. Judgmental methods. Judgmental forecasting methods incorporate intuitive judgments, opinions, and subjective probability estimates, such as composite forecast, Delphi method, forecast by analogy, scenario building, statistical surveys, and technology forecasting. Usage of forecasting can differ between areas of application. For example, in hydrology, the terms forecast and forecasting are sometimes reserved for estimates of values at certain specific future times, while the term prediction is used for more general estimates, such as the number of times floods will occur over a long period. Review the linked article for detailed information on the opens a new window percentage of sales method. Opens a new window. Defining spontaneous assets and liabilities. Spontaneous assets are the assets of a company that are accumulated automatically as a result of the firm's day-to-day business. Spontaneous liabilities are the obligations of a company that are accumulated automatically as a result of the firm's day-to-day business. Spontaneous assets, meaning, importance. Example: what are spontaneous assets? Spontaneous assets are balance sheet items that typically grow in proportion to sales, such as accounts receivable or inventory. Spontaneous assets are accumulated automatically as a result of a company's day-to-day business activity and are often included as a firm's current assets on the balance sheet. However, fixed assets, such as a factory building or equipment, often do not rise and fall with sales volumes and are thus not booked as spontaneous assets. Key takeaway: the spontaneous assets are those accumulated as a result of the company's day-to-day business operations. An increase in spontaneous assets is normally tied to a decrease in a company's cost of goods sold or an increase in revenues. Spontaneous assets often include accounts receivables, inventories, and working capital. Understanding spontaneous assets. The projected growth in spontaneous assets is an important measure for firms to consider as they evaluate the need to borrow. If the cash coming into the company is enough to cover operating costs, the business has a lower cost of financing or borrowing cash to cover costs. Similar to spontaneous assets, spontaneous liabilities move with changes in sales. Spontaneous liabilities are obligations of a company that are accumulated automatically as a result of the firm's day-to-day business. An increase in spontaneous liabilities is normally tied to an increase in cost of goods sold, COGS, or cost of sales, which in turn depends on the sales volume of goods or services. Working capital or current assets less current liabilities is critical to funding the ongoing operations of a firm. If current assets such as cash, accounts receivable, and inventory do not exceed current liabilities, a company may struggle to meet its spontaneous liabilities. Why spontaneous assets are important: the projected growth or decline in spontaneous assets is an important component for firms to consider as they manage corresponding accounts on the other side of the balance sheet. Spontaneous liabilities, which are typically recorded on a balance sheet under current liabilities. Current liabilities are short-term obligations, such as accounts payable, AP, and money owed to vendors or service providers. Working capital or current assets minus current liabilities is a key part of funding ongoing operations of a firm. If the major components of current assets such as cash, accounts receivable, and inventory do not consistently and comfortably exceed current liabilities, then a company may eventually find itself in a challenging financial situation to meet its spontaneous liabilities. Example of spontaneous assets, for example, orders for widgets result in the manufacture of more widgets that become sales inventory. Sales of goods also result in accounts receivable, AR, and deposits to company bank accounts as cash assets. These items can be considered spontaneous assets as they grow along with usual business activities. Spontaneous liabilities, meaning, importance. Example, what are spontaneous liabilities? Spontaneous liabilities are the obligations of a company that are accumulated automatically as a result of the company's day-to-day business. An increase in spontaneous liabilities is normally tied to an increase in a company's cost of goods sold or cost of sales, which are the costs involved in production. Fixed costs, such as the cost of a factory building, do not rise and fall with sales volumes and therefore are not spontaneous liabilities. Spontaneous liabilities are the obligations of a company that are accumulated as a result of the company's day-to-day business. An increase in spontaneous liabilities is normally tied to an increase in a company's cost of goods sold or cost of sales. Spontaneous liabilities often include accounts payables, which are short-term debt obligations owed to creditors and suppliers, wages, and taxes payable. Understanding spontaneous liabilities are called spontaneous because they arise from changes in sales activity. In other words, spontaneous liabilities are not directly controlled by the firm, but instead are controlled by sales or production volumes. Accounts payable are short-term debt obligations owed to creditors and suppliers. For example, if a company owes its supplier for raw materials used in production, the company would typically have time to pay the invoice. The terms for payables might be 30, 60, or 90 days in the future. Wages payable for those workers tied to production if there's overtime or added shifts as sales increase. Also, taxes payable might fall under spontaneous liabilities since the company's profit would rise with sales, leading to larger tax liability to the Internal Revenue Service. In general, any rise in sales will usually lead to an increase in the cost of goods sold, COGS, if the company is a product manufacturer, or an increase in the cost of sales, COS, if the company provides services. The upturn in COGS or COS is due to increased production and labor activity to replace sold inventory or support additional service sales. Why spontaneous liabilities are important. The projected growth in spontaneous liabilities is an important component for firms to consider as they manage corresponding accounts on the other side of the balance sheet, current assets. Current assets are short-term assets such as cash and money owed by customers in the form of accounts receivables. Working capital or current assets minus current liabilities is a key part of funding the ongoing operations of a firm. If the major components of current assets such as cash, accounts receivable, and inventory do not consistently and comfortably exceed current liabilities, then a company may eventually find itself in a challenging financial situation to meet its spontaneous liabilities. Example of spontaneous liabilities below is a portion of the income statement for Tesla, TSLA, as reported in the company's quarterly earnings on June 30, 2019 on Tesla. Form 10-Q, June 30, 2019, page 5. Excess January 29, 2021. Our key takeaways are as follows. Tesla's automotive sales or revenue came in at $5.1 billion from $3.1 billion a year earlier, highlighted in green. The sales or revenue increase in June of 2019 was a 64% jump in revenue from 2018. The company's cost of sales, or cost of goods sold, from automotive sales rose from $2.5 billion to $4.2 billion in 2018, highlighted in red. The rise in the cost of revenues in 2019 was a 68% jump from the same period a year earlier. Although Tesla's sales saw a massive increase year over year, the cost of those sales rose even more. The quarter for Tesla highlights how the cost of goods sold is a spontaneous liability and how it correlates closely with sales volumes. Also, the company's overhead costs or sales, general and administrative, SG&A, Expenses, highlighted in orange, did not correlate with sales, showing that SG&A is not a spontaneous liability. It's important to note that Tesla's results demonstrate the importance for investors to monitor the costs associated with generating sales and not merely a company's year-to-year revenue growth. Defining sustainable vis internal growth. Sustainable growth, as opposed to internal growth, gives a company a better idea of its growth rate while keeping in line with financial policy. Key points: the internal growth rate is a formula for calculating the maximum growth rate a firm can achieve without resorting to external financing. Sustainable growth is defined as the annual percentage of increase in sales that is consistent with a defined financial policy. Another measure of growth, the optimal growth rate, assesses sustainable growth from a total shareholder return creation and profitability perspective, independent of a given financial strategy. Key terms: retention, the act of retaining, something retained; retention ratio, retained earnings divided by net income; sustainable growth rate, the optimal growth from a financial perspective, assuming a given strategy with clear defined financial frame conditions/limitations. Essential reading. Question 1. This is not a form. We suggest that you use the browse mode and read all parts of the question carefully. Read the linked article and watch the video for essential information on sustainable growth. Radio opens a new window. SGR. Note: as a financial manager, ROE is an important goal to make and meet. By definition, your desire is to create the highest return possible for your equity holders. The DuPont allows you to decompose ROE into its three main components. First, net profit margin. Net profit margin equals net income/sales. It is a measure of the firm's efficiency in controlling its costs. It provides a measure for the amount of bang for the buck the firm sells. Second, asset turnover equals sales/assets. It measures how efficiently the firm is using its assets to generate sales. Third, the leverage multiplier equals assets/equity. SGR equals RO, 1 bit, where SGR is the sustainable rate and B is the dividend payout ratio, dividends/net income. **** Note: ROE may be calculated either directly as net income/equity or via the DuPont formula. SGR equals RO, 1 bit, equals 9/SXS/AXS/EX, 1 bit. Sustained growth rate. SGR. Definition, meaning, and limitations. What is the sustainable growth rate? SGR. The sustainable growth rate, SGR, is the maximum rate of growth that a company or social enterprise can sustain without having to finance growth with additional equity or debt. In other words, it is the rate at which the company can grow while using its own internal revenue without borrowing from outside sources. The SGR involves maximizing sales and revenue growth without increasing financial leverage. Achieving the SGR can help a company prevent being over-leveraged and avoid financial distress. First, obtain or calculate the return on equity, ROE, of the company. ROE measures the profitability of a company by comparing net income to the company's shareholders' equity. Also, inventory management is important, and management must have an understanding of the ongoing inventory needed to match and sustain the company's sales level. Sustainable growth rate, SGR, equals retention ratio x return on equity, ROE. Managing accounts receivable. Managing the collection of accounts receivable is also critical to maintaining cash flow and profit margins. Accounts receivable represents money owed by customers to the company. The longer it takes a company to collect its receivables contributes to a higher likelihood that it might have cash flow shortfalls and struggle to fund its operations properly. As a result, the company would need to incur additional debt or equity to make up for this cash flow shortfall. Companies with low SGR might not be managing their payables and receivables effectively. High sustainable growth rates. Sustaining a high SGR in the long term can prove difficult for most companies. As revenue increases, a company tends to reach a sales saturation point with its products. As a result, to maintain the growth rate, companies need to expand into new or other products, which might have lower profit margins. The lower margins could decrease profitability, strain financial resources, and potentially lead to a need for new financing to sustain growth. On the other hand, companies that fail to attain their SGR are at risk of stagnation. The SGR calculation assumes that a company wants to maintain a target capital structure of debt and equity, maintain a static dividend payout ratio, and accelerate sales as quickly as the organization allows. There are cases when a company's growth becomes greater than what it can self-fund. In these cases, the firm must devise a financial strategy that raises the capital needed to fund its rapid growth. The company can issue equity, increase financial leverage through debt, reduce dividend payouts, or increase profit margins by maximizing the efficiency of its revenue. All of these factors can increase the company's SGR. The SGR of a company can also be used by lenders to determine whether the company is likely to be able to pay back its loans. One sustainable growth rate versus PG ratio, the price-to-earnings growth ratio. PG ratio is the stock's price to earnings, P/E, ratio divided by the growth rate of its earnings for a specified time period. The PG ratio is used to determine a stock's value while taking the company's earnings growth into account. The PG ratio is said to provide a more complete. It's important to compare a company's SGR with similar companies in its industry to achieve a fair comparison and meaningful benchmark. Why is sustainable growth rate important? The sustainable growth rate is an important measurement because it gives a company an accurate picture of expansion and equity requirements. Not all companies want to take on additional partners or outside financing. So the SGR allows the company to toe the line when it comes to growth using their own revenues and capital. How do you calculate sustainable growth rate? You calculate the sustainable growth rate by taking the company's return on equity times the result of 1 minus the dividend payout ratio. Another way to calculate it is to multiply the retention rate by the return on equity. The retention rate represents the percentage of earnings that the company has not paid out in dividends. 2. It is the same formula, worded differently. How can a company increase growth? A company has many different ways to increase growth. A CEO could give a keynote speech that drives customers. The company could do a product rollout designed to maximize sales, or a company could increase growth by cutting costs, such as dividends or unprofitable divisions. The bottom line, companies need to stay on top of their growth rates, so the SGR is something that is calculated regularly. There may be a point where the rate is sustained at an elevated level, but that stretches the company thin and may dip too far into their cash reserves. At this point, companies will typically consider outside financing. Internal growth and sustainability. The true benefit of a high return on equity arises when retained earnings are reinvested into the company's operations. Such reinvestment should, in turn, lead to a high rate of growth for the company. The internal growth rate is a formula for calculating maximum growth rate that a firm can achieve without resorting to external financing. It's essentially the growth that a firm can supply by reinvesting its earnings. This can be described as retained earnings / total assets, or conceptually as the total amount of internal capital available compared to the current size of the organization. We find the internal growth rate by dividing net income by the amount of total assets, or finding return on assets, and multiplying by the rate of earnings retention. However, growth is not necessarily favorable. Expansion may strain managers' capacity to monitor and handle the company's operations. Therefore, a more commonly used measure is the sustainable growth rate. Sustainable growth is defined as the annual percentage of increase in sales that is consistent with the defined financial policy, such as target debt to equity ratio, target dividend payout ratio, target profit margin, or target ratio of total assets to net sales. We find the sustainable growth rate by dividing net income by shareholder equity, or finding return on equity, and multiplying by the rate of earnings retention. While the internal growth rate assumes no financing, the sustainable growth rate assumes you will make some use of outside financing that will be consistent with whatever financial policy being followed. In fact, in order to achieve a higher growth rate, the company would have to invest more equity capital, increase its financial leverage, or increase the target profit margin. Optimal growth rate. Another measure of growth. The optimal growth rate assesses sustainable growth from a total shareholder return creation and profitability perspective, independent of a given financial strategy. The concept of optimal growth rate was originally studied by Martin Hansche, Hans Lusch, and Bjorn Hayden. Their study was based on assessments on the performance of more than 3,500 stock-listed companies, with an initial revenue of greater than €250 million globally, across industries, over a period of 12 years from 1997 to 2009. Due to the span of time included in the study, the authors considered their findings to be, for the most part, independent of specific economic cycles. The study found that return on assets, return on sales, and return on equity do in fact rise with increasing revenue growth of between 10% to 25%, and then fall with further increasing revenue growth rates. Furthermore, the authors attributed this profitability increase to the following facts. Companies with substantial profitability have the opportunity to invest more in additional growth. Substantial growth may be a driver for additional profitability, whether by attracting high-performing young professionals, providing motivation for current employees, attracting better business partners, or simply leading to more self-confidence. However, according to the study, growth rates beyond the profitability maximum rate could bring about circumstances that reduce overall profitability because of the efforts necessary to handle additional growth, integrating new staff, controlling quality, etc. Defining additional funds needed, AFN. AFN is additional funds needed and refers to the additional resources that will be needed for a company to expand its operations. AFN is also known as discretionary financing needed, or DFN, and external financing need, EFN. Key points: AFN is a way of calculating how much new funding will be required so that the firm can realistically look at whether or not they will be able to generate the additional funding and therefore be able to achieve the higher sales level. The simplified formula is AFN equals projected increase in assets, spontaneous increase in liabilities, any increase in retained earnings. If this value is negative, this means the action or project which is being undertaken will generate extra income for the company, which can be invested elsewhere. The mathematical formulas used to determine AFN are based on showing how liabilities will grow relative to new assets in sales when a project is undertaken, and can be used as tools to determine whether a project or operational expansion is worthwhile. Key terms: asset, something or someone of any value, any portion of one's property or effects so considered; sales, revenues, liabilities, an amount of money in a company that is owed to someone and has to be paid in the future, such as tax, debt, interest, and mortgage payments. Additional funds needed. AFN stands for additional funds needed. It is a concept used most commonly in business looking to expand operations and influence. Since a business that seeks to increase its sales level will require more assets to meet that goal, some provision must be made to accommodate the change in assets. To phrase it another way, the business must have some plan to actually finance the new assets that will be needed to increase sales. Assets, economic resources. AFN determines the extra assets and financing that will be needed for a firm to undertake a new project or expand its operations and sales. AFN is a way of calculating how much new funding will be required so that the firm can realistically look at whether or not they will be able to generate the additional funding and therefore be able to achieve the higher sales level. Determining the amount of external funding needed is a key part of calculating AFN. This can be determined by mathematical formulas which use inputs that can be found in a company's financial statements. The simplified formula is AFN equals projected increase in assets, spontaneous increase in liabilities, any increase in retained earnings. If this value is negative, this means the action or project which is being undertaken will generate extra income for the company, which can be invested elsewhere. The more formal equation for AFN is defining capacity. Capacity adjustment takes into account maximum production levels and the alteration of this level depending on how the firm wants to grow. Key points: capacity planning is the process of determining the production capacity needed by an organization to meet changing demands for its products. Capacity utilization is a concept in economics and managerial accounting which refers to the extent to which an enterprise or a nation actually uses its installed productive capacity. When planning out how to manage capacity at the optimal level to attain the long-term goals of the firm, capacity planning and utilization and other processes should be analyzed. Key terms: capacity, the maximum that can be produced on a machine or in a facility or group. Capitalism, a socio-economic system based on private property rights, including the private ownership of resources or capital, with economic decisions made largely through the operation of a market unregulated by the state. Forecast, an estimation of a future condition. Adjusting capacity takes into account the maximum level of output that can be produced by a firm and how that can be changed in order to change the potential forecast of a firm's performance long-term. This involves capacity planning and management that will keep a firm from growing too fast in sales and making sure it is utilizing capital in the most efficient way possible. Capacity planning is the process of determining the production capacity needed by an organization to meet changing demands for its products. In the context of capacity planning, design capacity is the maximum amount of work that an organization is capable of completing in a given period. Effective capacity is the maximum amount of work that an organization is capable of completing in a given period due to constraints such as quality problems, delays, material handling, etc. Capacity utilization is a concept in economics and managerial accounting that refers to the extent to which an enterprise or a nation actually uses its installed productive capacity. Therefore, it refers to the relationship between actual output that is produced with the installed equipment and the potential output which could be produced with it if capacity was fully used. Implicitly, the capacity utilization rate is also an indicator of how efficiently the factors of production are being used. Much statistical and anecdotal evidence shows that many industries in the developed capitalist economy suffer from chronic excess capacity. Therefore, critics of market capitalism argue the system is not as efficient as it may seem, since at least 1/5 more output could be produced and sold if buying power was better distributed. However, a level of utilization somewhat below the maximum prevails, regardless of economic conditions. As a result, we look into capacity utilization to forecast a firm's success and growth numbers when predicting how financial statements will look into the future. The decision makers at the firm will be able to adjust this capacity in order to grow the firm in a way they feel is optimal. Defining discretionary financing need, DFN. Discretionary financing need is the difference between total assets and total liabilities and owner's equity. Video. Discretionary financing need, DFN. 621. Watch the video to learn about discretionary financing need. Discretionary financing needed, DFN. Appropriate methods for reducing a firm's discretionary financing need. Let's continue our discussion about discretionary financing needed, DFN, with an example. A firm predicted an enormously high growth rate of 25% for its coming year, bringing its previous $24 million in assets up to a future $30 million in assets, and it also projected $17 million in total liability and $10 million in total equity. While such high growth means great things for the company's profitability, it also requires that the management of this company raise an additional $3 million, $30, $17, $10 in external funding. If the company can't raise this sum because it has already borrowed everything the bank will lend it and sapped all available private investor capital, it may be forced to examine ways to reduce the DFN. There are at least 4 possible methods of decreasing DFN. Slow sales growth by increasing the price of its product. A firm can slow sales growth and thus reduce DFN in 2 ways. First, higher prices will likely increase net margin, leading to higher net income and more cash retained within the firm. Second, lower sales will decrease forecasted assets in the pro forma balance sheet, thus reducing the expected future financing need. While it may seem ludicrous for an entrepreneur or CEO to deliberately decrease sales, depending upon the elasticity of demand, remember that old econ term for the company's product. Slowing growth through increased prices may actually serve to increase total firm value and profitability. Examine capacity constraints, recheck capacity analyses to verify whether the firm really does need as large of an increase in fixed assets as was forecasted in the pro forma financial statements. It may be that, given the current capacity and usage, the firm can produce enough or near enough product without as large of an investment in fixed assets. Fixed assets is an account that often gets scrutinized whenever the DFN needs reducing. The firm may also consider outsourcing some of the increased production need. Lower dividend payout if we have estimated that the firm will bring in $2 million in earnings next year, but only retain $1 million of that within the firm. The remainder is paid out to investors in the form of dividends. If the company were to lower its annual dividend payment, thereby increasing its retention ratio, more earnings would remain within the firm and the DFN would decrease. The problem with this scenario is that stockholders normally do not react well to reduced dividends. Even when the CEO is able to explain to the shareholders the reasoning for the change and the opportunities it affords the firm, shareholders will still likely dislike and disagree with the cut. Increased net margin. The larger the company's net margin, the higher the level of earnings per dollar of sales. Higher earnings lead to more cash retained within the company, even without changing the retention ratio as in number 3 above, which in turn decreases the DFN. Besides increasing the product sales price, see number 1 above, the firm can also increase the net margin by cutting costs. Increased sales volume will help in this process as firms can take advantage of economies of scale and get better prices from their suppliers. There are also usually a number of managed expenses within a firm, such as advertising costs, that can be manipulated or managed in order to increase net margin in a given year. As we can see, financial planning is more than creating pro forma financial statements. Forecasted financial statements are easily manipulated. They accept whatever assumptions the analyst chooses to make regardless of whether those assumptions are reasonable or feasible. True financial planning, then, consists in understanding and considering the interactions among key variables when doing pro forma analysis. All aspects of the company's financials are interrelated in some way. Changing one variable affects all others. We have already seen this in our example above. Growth affected the DFN. If the firm then decides to finance the needed $3 million with borrowing, that will affect the firm's debt ratio, interest expense, and on and on. It is impossible to change one variable in isolation. The analyst, therefore, must be careful when making assumptions in financial forecasting analysis to understand how those assumptions will affect everything else. Example scenario: a firm has projected current assets to be $205 million, fixed assets to be $605 million, current liabilities to be $188 million, long-term debt to be $461 million, and owner's equity to be $106 million. Given this information, the discretionary financing needed is $55 million. What strategy could we employ to lower discretionary financing needed?